Hey, so good morning, active traders, and welcome to our Trading Week Ahead broadcast. But first, we're doing a quick Win with Ken episode this week, How to Set Your Entries Part 4 in our ongoing series of professional 10-minute trading strategy sessions. By the way, how many of you like this idea of doing quick quick bite-sized professional hit and run strategies that are short and to the point and concise and accurate and specific? Is this a good format, or do you like the hour-long, boring-ass webinar format? Personally, I have a short attention span, so I like to hit the ground running. But tell me if you like these short, quick, brief videos, and we'll continue on if that's the consensus. As always, all information is for educational use only. We're not making advice about what to buy, sell, or hold. And by watching this, you agree not to make actual trades. It's all for a safe learning environment. I'm a real money trader. I've done as much as 4.9 million in a single year. Boom, worth of trades. So hey, I'm the real deal. Our main idea this week is to enter 50 cents or so above recent large candles. And let's go ahead and take a look at some examples of that. Wanted to welcome all of you here. One of the things visually to keep an eye on is keep your eyes peeled for large, and by large that's kind of a subjective word, at least 1.5 times the height of the average whole real body candles. So does everybody see how this is a large candle and that qualifies compared to these flat melted candles? Or here's a reasonably large, maybe medium sized, but large enough candle after these smaller candles. Well, what I look for is a trigger point that's at least 50 cents above the high. Now, if that would put us under resistance, as here, we add 50 cents to this high. So we have a shooting star right here and a pullback, but this is a large green candle. This is the candle I wanted to draw your attention to, though. Look for large candles in context of a pre-existing uptrend and then add 50 cents or so to it to help set your entry. And the reason I say 50 cents, you may want to use smaller for stocks under $10 or $20 a share, maybe 20, 30 cents, but some safety buffer value above the obvious resistance, because often you'll see people will get in and then it gets pulled back and then they get stopped out and then it runs without them. So wait for the 50 cents or so above the high of the candle to get in. Here's Pfizer, PFE. Another example of a mid to large cap Roku, which is a nice gap continuation runner. Large green candle moved over here. We got a reasonably large candle up here right under the 66 whole number. So where would we enter Roku? Where would be a likely and smart place to enter this trade? I'll be looking to trade it over 66.5 if we get north of 50 cents above this large candle. What I mean specifically by large candles is not something like these, where these are small, when something preferably large like this or like this or like this. Now for cheaper charts, here's an example of a mean reverting chart in V-Ray, a stock that had been a $7 stock that became a $13 stock. It almost doubled in value. It was almost a doubler. Boom. But then it pulled back down to around 50% of the trading range. Started a bounce. You could go long over, say, 1020 or 1040 and take the shot. But the large green candle is this guy right here. So if we call that, let's round that up, let's call that 1070. If we call the high of the candle 1070, where would you enter it if you're going to add 50 cents to enter the long trade? Using this green signal candle, a nice high volume candle, as a early warning sign that buyers may be back in. They weren't, right after this big green candle, it sold down again, so we don't want to fool around with it in here. We don't want to buy it right at resistance. That would be the dumb money entry, would be right over resistance. I should know I used to be the dumb money and I'd always get stopped out. And after a few thousand times of getting stopped out, you get pissed off. You say, stop the madness. There's got to be a better way. So that's why I developed the safety buffer technique, where you put some region, you wait until some region above the obvious resistance, the dumb money high, before getting in. So right up at 1120 or so. So way up here with an exit target of maybe right under 13. So the sweet spot of the trade would be 1120 to say 1280. That would be the play, right? And then if it keeps going up, we can always rebuy over say 13.5, 1360. but with resistance here at 13, I want to say 1320 or so. I'm trying to eyeball this chart. With resistance at, I was right, at 1320, we want to wait, for a new trade up over, say, 1350, 1360. But anyway, that's my point. And again, you could use that same strategy. 50 cents above the high of this whole real candle would be 1370 for an entry. Anyway, the point is, look for these large green candles in context of a pre-existing uptrend where they exist, or following a gap. Oftentimes what you'll find, and I'll tell you, I've been trading gaps for so many, almost 20 years now, often you'll find a gap day that's a large day, followed by a pullback or quiet day, and then it continues to take off. Other times you'll find a chart like this. We got a gap up day that had a big green signal day, and it ran all the way up here from the $8 a share up to $12.50 a share for a big 50% run, and then a sideways congestion. Okay. So if we use this as the most recent large green candle, which it is, and we just say arbitrarily add 50 cents to it, the long trigger would be up near 1270. See, where you get into trouble, where I used to get into trouble at least, and tell me if you agree with me or disagree with me on this. Say aye if you agree with me. If you try and buy bounces too soon, that usually ends badly and you get stopped out because it goes up a little bit, gets your hopes up, it runs a little, and then it collapses back down. You get stopped out, and then it runs up without you or not, and it gets frustrating. And what you want to build is a trader's consistency. And to build consistency into your trades, you need to trade at price points that are likely to attract a wave of new buyers, a rush of new money coming into that instrument. And that doesn't occur in these inside range areas. So avoid trading inside box ranges and instead wait for breakouts, and using the large green candle approach can help identify that for you. Or if you see a large green candle at the right side of a congestion box or a bullish cup or whatnot, those large green breakout candles are something I've taught traders nearly 20 years to look at, and that's one strategy that I think can really help. Well, thanks, traders. I appreciate all the kind words. I think it's great. Appreciate that. I'm trying to read all these comments. Anyway, so visually, I want you to become more visual and math in your trades rather than simple patterns, because simple chart patterns often get stopped out, right? If you look for things like a simple cup pattern and you buy right above the high of the cup, often that'll be a false breakout, or an ascending triangle, or just a steady uptrend. Often you'll get stopped out if you're not trading the right charts with the right combination of signals. Okay, and an easy combination is to look for large green candles and then mentally resolve not to trade right above the resistance area. See, it wouldn't surprise me at all. Let's say next week this thing chops and drops, but the week after Wall Street resumes and business as usual, wouldn't surprise me at all to see this guy run to 1240, 12.5, stall, and then come back crashing down. And then a week later runs up to 14 without people. So resolve to avoid right above highs and use that safety buffer technique. So again, for the cheaper charts, you may want to use something tighter than 50 cents above recent highs. But that's a good rule of thumb that I think can serve you well as an active trader. Be on the lookout for charts like that. Another visual cue that I've taught for years is to look for the ratio of green to red candles in the last 5 to 7 days and give preference to those charts that have mostly green candles, maybe 70-80%, 5 out of 6, 5 out of 7 candles are green, preferably with at least one or so large green candle as part of the mix, as a visual price action cue that buyers are in charge of the instrument, right? So we can see large green signal candles that run up. You got a reversal sign with a bearish upper shadow here. This guy runs back down. Now it's starting to go back up again, up and away. And these are the kind of charts we want to make sense of as an active trader. You also want charts that have consistency, okay? Like Square had been one that I've been telling traders since the start of the year would be a good trade, right? That was a featured chart in my Bitcoin's Bonanza course that I did back in, I want to say, February. So congratulations to all of you who bought Bitcoin's Bonanza and profited from it handsomely. I was calling this guy, I know there's several others too, but Square was a key one of the mix. And this guy ran from a $30 a share stock to a $90 a share stock. Tripled in value. Steadily. You could have scaled in or position sized, added to winning trade on the way up and done extremely well. Now it's way up in the sky, up at 90 a share, so it's kind of rich. I'm not going to buy it up here, but this is a good one to play on the way up. And as you're looking for trading candidates, you want to look for patterns that repeat, whether it's large green candles that continue to run, like this guy. So there's a large green candle. If you'd bought 50 cents above the high of that guy, around 74.5, 75, you'd be sitting pretty to the tune of 15 points, triple fives, right? Professional traders, we like charts with lots of money, all right? I'm in it for the money. To quote Han Solo from the great movie Star Wars Episode 4, A New Hope, I'm in it for the money. I'm not in it for the princess. I'm not in it for the rebellion. I want to get paid. If gold is all you want, then gold is what you'll receive. Good, pay me. And then I'd put in a MF expletive. Anyway, the point is, look at this guy. 36 all the way up to 42. It's got a 6-point trading range with consistent uptrend. Right now it's pulling back, so I'm not too excited about it right now, especially after a big red candle. That's kind of a contrary signal. But if we do get a new high breakout somewhere north of 43, count me in. Maybe it runs to 60. I don't know where it's going to go from here. But all I know is the directional volatility, the theta is really good. And so, if you're looking at buying the underlying or selling puts or buying calls or doing something like credit or debit spreads or iron condors or butterflies or whatever, whatever you're doing, whether it's options or trading the underlying, be on the lookout visually for these kind of chart patterns, because I think they can really help. So that'll conclude this micro episode of Win with Ken. Let me know if any questions. We got a couple of minutes till today's official Trading Week Ahead broadcast. I wanted to thank all of you for joining us here on a Saturday, September 8th morning. What's our turnout? We got 5,400 of you who have registered. That's really big, so thanks to all of you for being here. It's great to see. That's called social proof that, hey, this is the right place to hang out, right? Or at least 5,474 other traders think so, so you make the call. But thank you so much for making these popular. I'm going to give you good, honest training that actually kind of sort of makes sense on the average, right? Let's see, a question from James. Can I discuss scaling in and stop losses? Sure. Usually, a good example is, a great example would be a pick that my Swing Scans members got, which is SeaWorld, SEAS. I called along at 28 something. I want to say 28.50. It's in the chart of the week a couple weeks ago, and then again at 30.20. When you get into a good strong chart, you always want to build the trade by adding to it. So I like to use it, as in this case for my Swing Scans members, I told them to get in the 28s, and then again over 30.2 was the second long. I think the first one was 28.20, the second was 30.20, something like that. Every 2 points on stocks in the $20, $30, $40 share range makes sense to build the trade to add to. Initial stop should be around 2 points as well, or a 2-day low. So for example, folks, if you were long SeaWorld, where would you trail a stop using a 2-day low reversal strategy? Under what value would you trail a stop? Let's say you're long. Let's say you paid attention to me and you actually got into this thing and you're up in the money and you're happy about it and you're thrilled that you're a Swing Scans member because this is one of our picks the last couple of weeks. You're welcome, but the trick is getting out with the money before the Wall Street takes it back from you. So where would you trail a stop in this guy? Maximum drop dead stop. You shouldn't say, I don't know. Guess. There's no wrong answers. I'm not going to bite your head off if you. So this is the part where you post a quick answer. We officially start in less than a minute, so you got about 30 seconds. Let's see. Hit me with your best shot. What do we got? 31, 29.50, 30.48, 31.30, 30.30, below 30, 30.50. No, 30.80. I'm sorry, 29.90. Hey, Nan. 30.50. Hey, Murray. 29.5, 30.50. I'm seeing these scroll by 28.80. Okay. The maximum drop dead stop loss on this trade would be somewhere under a 2-day low, which would be slightly under 30. And personally, I would use 29.8 because I don't use even numbers because oftentimes it'll bounce off of that, or with a nickel or dime to spare. And so that's kind of from a real money trader, I'll tell you, that's how the actual real money trades work out. So what you want to do is I'd trail maximum drop dead stop on a swing trade in SeaWorld would be 29.8. That would be the correct answer. And the other flip side of that is, where would you add to this guy? If we're up at, let's say you're looking at it for the first time, where would you add to this trade? We're at 31 and change. Let's call the high 31.6. You would build the trade 2 points above where you most recently got in at. But if you're new to let's say from here would be what? Maybe 33.6, right? So you would scale in. Maybe this guy runs to 40. You want to profit from that by scaling in over and over again. Now you could have, if you're a swing scans member, you could have taken the first entry in the 28s and just let it ride and be a happy camper. But you should be happier if you bought the secondary entry at 30.20, and now you're up even more with the unrealized profit in the trade. So anyway, good stuff. And thanks for all of you for answering. I appreciate it. Let us get underway with today's live broadcast. So we are now on air. I wanted to welcome all of you to this week's episode of Trading Week Ahead. I'm Ken Calhoun, your host, broadcasting live straight out of Colorado here on Saturday, September 8th, 2018. I wanted to thank all of you for being here. I hope that you're making boatloads of money in the market, despite this last week's pullback. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold on. By watching this, you agree not to make actual trades, you crazy kids. Practice. I was talking with a trader last week, and he said he wishes he had listened to me and done paper trading instead of trading live account and losing money. So paper trade and learn for a few years before you even think about trading live. Just a reminder, I do have the 3-week trials. It had been 2 week, now it's 3-week trials for swing traders at swingscans.com, just $7. Or if you're a day trader, tradingopen.com, $7. And you can see why so many hundreds of people have joined. So our quote of the week from Sun Tzu: the supreme art of war is to subdue the enemy without fighting. And to paraphrase for active traders, I'd say the supreme art of trading is to make money without losing much, or without fighting with the market. If you're fighting the market, you're in a losing battle because the market has more depth, most likely in terms of money, than you or I have. So we're mere mortals. We want to make money from the markets without fighting. The way to do that is to start small and then incrementally scale in or build your trades over time. Okay. Our coaching tip of the week, volume patterns, part number 2. I want you to follow the volume. What's volume doing on the day after a gap day, or the second day after a gap day? Is the volume shrinking significantly? We always follow price, of course. Is price going up, down, or sideways? But in addition to that, what's the volume on the day after the gap? Okay. I've got a couple more tips on how to do that for my Swing Scans members coming up in around 27 minutes. So stay tuned for that. Let's go ahead and jump into our markets. And again, thanks to all of you for being here. Our capital market, S&P, has been going down. Here's the S&P on a 15-day chart. Let's take a look on the 90-day. Well, thanks, everybody. Appreciate it. And Marcelo saying, Sun Tzu, win the trade before you get in it. Yeah, that's absolutely right. In your mind, you got to figure out what's the and I use price projection. I'll draw out. I frequently do this, especially for my live room members. I draw out the long and the short path of where price action is most likely to go. If buyers come in, it goes up. If sellers come in, it goes down. How far and how do we time our exits as well as the entries are a really critical piece of the puzzle to solve right. I love trading because there's infinite money, practically infinite money, and it's always keeps our mind sharp by solving these puzzles over and over again. Anyway, our S&P key support resistance levels, let's use 2905. I'm not going to wait for over the 20. We're going to use a reversal over 2905 as R1, okay? A little tighter than average. And the S1 trigger to go short Abandon all hope, ye who enter here. 2854. So 2854. 2854 is our support one, our S1 trigger, and 2905 is our R1 trigger. I always keep a text notepad so that I can remember these things. Anyway, there it goes. Now let's take a look at some charts, shall we? One of the first charts to bring to your attention is ARWR. And this is one that I had mentioned for my live room members, 18.6, the long call right here is a breakout. This is one to keep on the radar for the week ahead, particularly for intraday trading, because the profit potential is enormous. This guy ran from 1650 to 2250 almost. So nearly a 6-point run on a $20-ish stock is epic on big volume of over 100,000 shares. So lots of volume. As traders, we like volume and we like volatility. So the two V's are what we want. This is the type of chart to day trade. And that's where I told everybody to go long, right there, which turned out to be exactly right. It's right above the resistance area. Got us in and it swang, ran up. Did a mean reversion, pull back to the 50% waterline, kind of going sideways from here. What's next for this? It'll go up, or it'll go down, or it'll go sideways. I don't predict, I react. I'm a professional. I know where I'll go long. I know where I'll go short. I know where I'll stay clear if it goes sideways. But in the meantime, this is a really good one, especially good for intraday, ARWR. Next up to bat, we've got SEAS. SeaWorld is one that my Swing Scans members had been alerted to the last 2 weeks in a row with 2 winning alerts in a row. So that's cool. What I like about this chart is the epic tight channel. This is a good role model of a near perfect, it is a perfect chart. Charts don't get more perfect than this. Earlier charts that were near perfect are ones like what, Netflix, Nvidia, Square, Disney a few years ago. Anyway, when you see a chart that's got a nice clean tight channel that runs like this week after week after frickin' week, you know, if you could only go back in time and buy into it, then scale into it, then add to it again, you could have done extremely well with immense potential profits in this kind of chart, right? If you pull back to the daily chart, you can see another spectacular run. After the gap to 25, it's now up to just under 3150, 32 region. The other thing to look at visually, again, is the ratio of green to red candles over the last 2 trading weeks. And you can see in this chart it's all green except for 2 red candles. So we've got 3, 6, 9, 11 greens and 2 reds, right? So that's spectacular. That's a good over 80-90% of green candles with a nice large green signal candle there in the mix as well. So that's a good chart. Here's the last chart. Here is a inexpensive chart, SENS. For those of you who trade cheap charts, I thought this one might be one. I believe that's in our, this is one of the small cap scans picks of the week, SENS. And if you do trade stocks under $10, you've absolutely got to run, not walk, to smallcapscans.com and register with me for a 3-week trial for the low price of just $7. Get my top 7 picks plus a video each week. I just recorded one last night for my members. Anyway, we've got a nice uptrend continuation in SENS going from a base of around 330 all the way up to 4.5. So a nice steady uptrend. You know, trading is a lesson in frustration, and it's a lesson in missed entries, and it's a lesson in inconsistency, and it's a lesson in losing a lot of money until you turn the corner and you start figuring out the difference between what makes for more successful trades versus those that stop out. You know, traders ask me all the time, how do I get more consistent? My answer is simple: trade more consistent charts. I like the whole saying garbage in, garbage out. If you're trading garbage charts, like I always pick on AT&T, but that's because it's such a perfectly awful chart. If you're trading garbage charts like this one that don't have any directional volatility to speak of, or cheap charts that do pop and drop penny stock type crap, that's a bad idea. What you want to do is start getting on board with more consistent charts like the ones I teach that have better continuous trends and better volatility, right? Better profit potential. So that's one thing that I'd urge you to do as well. What else is going on here in our markets? Gold and oil are not really blowing my hair back. Dust, I told you, was going to go up off the 38, and sure enough it did, right? It ran all the way up here to 45, 46. So this is the inverse gold instrument called dust. It's what happens to gold when it gets dusted. It's inverse ETN. Anyway, this puppy did a mean reversion pullback here, bullish engulfing. Again, for more on candlesticks, learn from my colleague Steve Nissen at candlecharts.com. Anyway, bullish engulfing here, sure enough worked out, and dust is up, up, and away, up to new highs near 46, 47. Be sure to order StockTradingSuccess.com if you're not one of the hundreds of traders who've already been thrilled with that system that Steve and I put out years ago. www.StockTradingSuccess.com. You see why so many hundreds of people have written in with testimonials. Or over 100, I should say. Anyway, mean reversion pullback, bullish engulfing, schwang, and it's up to a 90-day high. This is dust. This is how we short gold, right? When gold is down, if you look at, say, GDX or Gold Corp, gold looks bearish, right? They've been selling gold for the last 2 months. So for that reason, dust is a really good candidate for an upside play if it does continue on up, and we'll see if it does. Well, thanks, traders. I appreciate it. Question from Shannon. Could I please say how to scan for trades? Well, yeah, I mean, visually, you look at leaderboard scans. You know, I look at the percent gain and loss list daily, and I scrub through all those. I go through hundreds of charts on behalf of you folks, my traders, and I bring the cream of the crop, you know, like the top 5 or 10 or whatnot, to you folks in my subscription services, so that you don't have to visually scan through everything. But, I mean, if you want to take hours of your life, and even then you won't know where to enter, right? Look at your leaderboard scan, your percent gain and loss list, and, you know, click through these puppies and see who makes sense to trade. But I'm a classic old school trader, so that's what I'm always looking at is the leaderboard scan, the percent gain and loss list. That's 4 lists to look through: the percent gainers and percent losers in the New York Stock Exchange and the NASDAQ markets, and you visually go through the ones with the highest volume and the best net directional volatility. So good stuff. Oil looks completely uninteresting to me. UCO and USO going nowhere. So from an oil and gold commodity standpoint, I like dust. I didn't see any outlier charts in the sector chart scan, so I don't see anything strong saying banking or finance or whatnot. So I don't see any industry group or sector specific relative strength that's worth a note. Just short and gold is one. And then some of these outlier charts that have good directional strength as well. For currency traders, the US dollar to the Canadian dollar, is the best one. The dollar CAD is running up to just around 131-ish, 132. If you are a Forex trader, be sure to register at www.forexvideos.com, the site that I run with my colleague Peter Bain from Forex Mentor. So forexvideos.com. You get my top 3 picks plus videos from a live Vegas seminar Peter and I did and our previous webinars. So that's a subscription service as well. Anyway, if you're a Forex trader, that's the best directional swing trading chart I can find is the US dollar to the Canadian dollar, the dollar CAD. Some of you still trade Forex too, so good charts. Anyway, as you look for these patterns, remember to be on the especially keen, you know, kind of make the chart prove itself to you. Make sure that you're looking for charts with large green, high volume breakouts, because that's, you know, what happened. Those are the winner. You know, that's the winning day. We get a large candle. You don't buy right above the obvious high because that's often going to do a false breakout. You need to be a specialist in several things as a trader. The most important one is not technical analysis. The most important one is risk management and keeping itty-bitty tiny stops when you screw up, which is going to be at least half the time. How do you still make money as a trader if you screw up at least half your trades? The answer is itty-bitty super tiny stops when you're wrong. Look at hundreds of examples of real money trades on my forum at tradingtalk.com. Over 130,000 views. It's a popular thread with real money screen caps, including from this year, not just the old ones, real money trades I did. Anyway, the point is, how are you going to make money if you screw up at least half the time? Because I still do, and you will too. For the rest of your life, you're not going to beat 50% winning trades. The only way out is through. The only way out, I guess in therapy they'd say that. But in trading, the only way out is itty bitty tiny stops when you screw up. So if I'm wrong in a trade, if I'm down 150, 200 bucks, I'm going to get out with a tiny, a tiny razor cut or something, a little tiny haircut. If I'm up in a trade, say 800, 1,000, 1,200 bucks, I'm likely to tighten in a trailing stop or go to cash, lock in the money, take the money out of the market, and then rebuy only if it takes out a new high, which usually they don't, at least not in the way you think they will. So it's kind of a trick to the trade. Tips from a real money trader. I can tell you, it's not about throwing Hail Mary passes and thousands of shares, because often, let's say you buy up here and then you get stopped out and you lose a lot. You buy again and then you get stopped out again. You can't trade like that. You need to trade charts that are consistent. And if you do trade bounces or you do trade more haphazard charts, you want to make sure that you combine risk management with position sizing and scaling. That's really critical that you get that right. So anyway, I hope this has been helpful. I got a few minutes left. Hey, Jack. It's a question from Mike. It says, my profits are very small and stops are too large, seem to enter too late. That can be a problem. The trick to that is you got to figure out the best of the directional charts that have enough pre-existing uptrend strength that's likely to carry the trade forward for you successfully in the upper right side of the chart, right? It's not enough just to identify big monster breakouts. You need to find where to get in a place that's likely to continue on up. A question from Trader Shannon about how to scan for trades. Yeah, just looking at the leaderboards. But again, I do the scanning for people so that you don't have to. I don't put out any proprietary scanners or magic indicators or black box software or that kind of crap. I'm old school. I roll up my sleeves. I visually look at charts that I think are most likely to make money, either ones I'm currently trading or planning to trade, and ones that I want to share with my members, and I make that the core of the business, which is why it's been so popular. So thanks to everybody for being here. You've seen how good my alerts work out. I think what's more important is not give you the fish, but teach you how to fish with the thinking behind how you approach your trades. And the mechanics of your trade is much more about tight risk management, playing a field of multiple positions, trading what I call trade wide, not deep. Make sure that you are trading directional volatility intelligently in a way that when you're wrong is likely to not cost you much. So those are kind of several core skills. One is, of course, risk management. The other is you do need to have some technical acumen to identify charts that identify a history of behavior of the traders from a volatility and a price projection, a breakout standpoint that's likely to continue on after you put on the trade. Your goal is to kind of buy wholesale and sell retail as a trader. Your goal is, if I buy 43 and change, let's say I buy 43 and a half, I'm going to look at that as a wholesale price, even though maybe wholesale will be down at 36, but I get in at say 43 and a half. I'd only do so if I think I can trade that. I'm a trader. It's what I do. You remember, you are a trader. Kind of like Trader Ken or like the great store Trader Joe's. You're a trader. You're a trader of instruments. You want to buy at one price and sell at a price favorable to you to bank a profit. The other big missing piece of most traders' toolkit is the profit extraction, the profit taking mindset. And often I will tell traders, if let's say we're looking at a day trade in ARWR, I got them in at 18.6. I was fine to have a sell a bit early, even if it's just you're getting a point or two out of the trade. That's fine. You don't get the bottom, you don't get the top, you get the meat in the middle, whatever you want to call it. The taking of money before the market takes it back from you is a core skill. And when in doubt, get out. When in doubt, go to cash. The slightest inkling that the trade may start to go against you, listen to that warning sign. Look at it like a friendly elf on your shoulder saying, sell, 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 and get out before the market takes the profit back. Because it will if you screw around and wait, Good professional trades, like I've said for years, are usually, they feel like you're kind of late to get in. Like, really, am I going to wait all the way up here to get in? And then, yeah, I'm going to get out at the first sign of trouble. Late to get in and early to exit. And most traders have that kind of ass backward where they're jumping the gun and you guys are chomping at the bits to get into your trades like you're in an action adventure movie. You pull the trigger like you're blazing away with a machine gun, and you don't know what you're doing, and you just get yourself hurt because you get stopped out too often. And to avoid that pain and that frustration, I would urge you to kind of learn a more careful approach. And that's what I teach in my various courses and alert services. So anyway, thank you all for being here. I've got to run. I got swing scans in a few minutes. Your goal is to make as much money as possible with your winning trades, right? So remember, the 7-day trials are there. 21-day trials, just $7. I am now limiting trials to just one per person, lifetime max, not just one per year. So if you've already done a trial, join for a month. You don't have to stick around if you don't want to, but you can see why so many hundreds of people have been members over the years, because they value the training. And I like to give you good, intelligent, honest, disciplined, actually makes sense training. That's kind of roll up your sleeves as a mechanic, trying to hustle whatever you can out of the market. You're grinding your trades, keeping really tight stops, and making it work. So join me at SwingScans and or TradingTheOpen.com, and I will see you guys on the other side. So I'm going to wrap it up for now. I wanted to thank all of you for being here. And again, I apologize in advance for not being able to answer all the many questions that you folks ask. I got a lot of you here. Let's see if I have just a question or two I can answer. Question from Don: should the trend determine your bias in day trading, long or short? Yeah, the trick is how far of a length of a trend. But yeah, always. I'm always looking. My favorite pattern is small gaps that continue. So I'm always looking for, say a medium to large 1 minute green candle following a gap of 50 to 80 cents or $1 above the previous day's high on high volume. That's usually a really good signal that they're piling into it and likely to go up. So yeah, the trend is absolutely critical. Hey, sure thing, Dave. Hey, you're welcome, TJ. Thanks, man. I've got to run. You guys are very supportive. Gold is a W pattern forming. I don't see one. Gold still looks bearish to me. So when it comes to reversals, I found the hard way that oftentimes you'll buy the dead cat bounce or catch a falling knife more often than correctly catching the big pivot that runs significantly. That's very rare. I spent the first few years of my trading life trying to catch pivots because I thought it's kind of like a department store mentality. You want to wait till it goes on sale and then you buy it and hope that you got it cheap and it's going to bounce. Epic fail. That usually doesn't work. Usually what works is to buy high, sell higher, not trying to buy bounces. So don't make the mistake I made years ago of trying to become an expert in pivots. Learn the pivot signals, whether it's candles like shooting stars or bullish or bearish engulfings or hammers or whatnot. But trade the breakouts and use the pivot signals to manage your exits, to exit stage left and dodge a bullet. So lock in a profit on the way up, get out at the first sign of trouble, and don't wait till later. Well, thanks. Trader's saying thanks. Great session. Appreciate that, Nan. All right. Well, thanks, Dave. Thanks, everybody, for being here. I do appreciate it. I've got to run. See you guys next Saturday. Do try out my alert services. You have my word. I put a ton of work into those for you guys, and I do all the heavy lifting. I exercise a lot now, so I do heavy lifting, or not heavy, but I use the weights and everything. I do the lifting for you in terms of scanning visually for charts that I think have the best odds of working out. So do try www.swingscans.com if you're a swing trader, or if you're a day trader, try tradingtheopen.com. And I'll see you guys on the other side. Take care. And until next time, trade with passion, trade with itty-bitty stops, make lots of money, and let's go get them. See you next time. Bye for this week.